Hello, and welcome to Fireside with the VC. My name is Andrew Romans, and today I'm very psyched to have Bryan Ciambella join us. Bryan, thanks for coming on the pod.
Thanks for taking the time. Good to catch up.
So, Bryan, normally you're in New York, but a lot of the people I know from New York, I heard something like 90,000 people moved to East Hampton alone in like the month of March and April. Are you in the city again, or where are you these days?
Uh, yeah, no, it was definitely everyone seemed to flee a couple months ago, but I was upstate for a little bit, but came back about a month and a half ago. I think city's starting to get some legs, so we came back and started to do walk-in coffees in the city.
Yeah, yeah. So I'm in the valley. Walking meetings has been what's been happening, and sometimes you're walking, you're like, dude, we're walking awfully close. I don't know if we're better off in the conference room, but it's cool. Okay, nice. Well, listen. So Bryan, I'm going to kind of quickly go through some of your past venture experiences and then bring it up to now. But starting off, you founded your own company, right? Weren't you? Didn't you have a venture-backed company yourself? Was it Amped Fantasy? Is that right?
Yep. So when I was in grad school in London, I founded kind of the first daily fantasy sports gaming company pre FanDuel, pre DraftKings. So kind of non-salary cap daily gaming. So built the team, built up the platform, so you could kind of pick the top fantasy players for football and baseball and soccer. So it's kind of a great experience. We ended up selling it to the Global Gaming Network, which is based in California, who kind of powers the daily fantasy sports games for a lot of bars and pubs throughout the world now. So kind of helped scale up that I'd say 12 years ago.
Well, that's great. And did you raise capital yourself for that company, or did you manage to bootstrap it?
We rose some capital from Innovative, which is based out in New York, and they kind of help with the tech platform. And then we have some angels kind of came in to help scale it. But as most betting industry and gambling companies are, was relatively cash flow positive from the early days. So it was a good experience, and big fantasy sports player. So kind of marrying business with pleasure.
Yeah. I mean, as much as I'm a venture capitalist and that's what I sell the world to the LPs and the entrepreneurs and grow faster and all that, there is something cool about starting a company that doesn't need outside investors and there's no liquidation stack. And when you sell the business, that's yours. And there's not a huge credit card to pay back on all the money you raised. So there's advantages to that, or even selling fast sometimes. Well, tell me about Rocket Internet. I think the Samwer brothers are largely misunderstood outside of, some circles in Germany. But I know you weren't working with them for very long. But I think sometimes Ollie Samwer is famous for the 30-second meeting and like, go, 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 go. And I think a little injection of that can be good for somebody. If you stay with it for too long, I don't know about that. Tell us a little bit about your experience of working with the Samwers at Rocket Internet.
Yeah, so I think definitely a great experience. Rocket obviously has done some impressive things in the U.S. and abroad, but was recruited by an individual called Pick Carbe, who was running kind of HelloFresh in the UK to launch HelloFresh in the States. So ended up the first hire I made was a good friend of mine, Dan Treeman, who has a lot of, let's say, food operations experience, and we worked together kind of with an army of interns in the beginning, scaling up the HelloFresh platform and product today, kind of setting up the distribution centers and getting the product up and running. Obviously, fast forward to COVID times, 10 years later, I think eat from home and food delivery has obviously experienced kind of tremendous growth, but it was great in the early days kind of scaling the business, especially kind of what has happened now with HelloFresh globally, and Dan has kind of remained a good friend and actually work with him today on a few ventures. So it was a great experience, and I think the Rocket model, even though it's kind of gone through different iterations, is definitely kind of impressive what they were able to kind of build and scale.
So Rocket Internet is now publicly traded evergreen fund, right? Isn't it?
They are publicly traded. I thought I saw last week or 2 weeks ago that they were taking it private again. But I know, some companies have, spun out to their own kind of public vehicles. So that the broader entity, I believe, is kind of going private again.
Okay, that's interesting because I find it sometimes even odd that we have this 2 and 20 structure with the 10-year term where especially if the VC is raising a new fund every 2.5, 3 years, they're motivated to put some points on the board and get an exit to juice their ability to raise that next fund. And, or, I've heard the average VC fund can even have a 14-year lifespan. I mean, they're usually 10-year term with the ability to extend to limited partner consent. You can say, let's not sell right before the Facebook IPO. We've been in it for 9 years, you know? But if you have a publicly traded company, there could be liquidity for the investors, the LPs, and less pressure to almost abandon the entrepreneur or force them into an exit. I was just wondering, with your experience with Rocket, did that change your view, or maybe
Uh,
wasn't?
yeah, no, it's a good question. I mean, haven't stayed super close to the Rocket internet story, so probably can't comment directly on them. But I think just broadly with SPACs and direct listings, I think the evolution of kind of that growth and I'd say pre-IPO company has changed dramatically in the last 6 to 12 months. I think outside of the amount of SPACs that were already available, I'd say the leading kind of tier one venture and growth guys that are deploying SPACs now has really kind of changed, I guess, how you think about liquidity. So TBD how it all shakes out, but definitely evolving kind of before our eyes today.
Yeah, no doubt. It's interesting to see. We had the rush the public markets for venture financing in the late '90s, and that blew up like dynamite in a bad way. And then you had this Sarbanes-Oxley slow crawl into the too expensive, why bother, don't want to pay for the compliance, to secondary market, stay private forever. And then now a realization that, like, it's probably bad to not have the ability to acquire a company with the public and that entire thing. I think the US economy is robbing itself from not allowing companies to go, public earlier. And the SPAC seems to be this bizarre, cheaper, faster way of doing it. Um, that we're living through now. So we'll see where that leads us. But okay, let's talk about B Capital Group and then move on to your current stuff. So B Capital Group, founded by Raj Ganguly from Bain Capital and Eduardo Saverin, from co-founder of Facebook. And then I guess you had Howard Morgan, co-founder of First Round, as the chairman. And there's this special relationship with Boston Consulting Group. You were there for like a good 4 or 5 years, right? Or
Yeah, had the privilege of moving out from New York to LA about September of 2016 or 2015. So kind of helped in the early days, kind of pre-fund. Obviously, as you mentioned, kind of a pretty incredible team given Raj and Eduardo's kind of operating and investing experience, and kind of a unique model with the Boston Consulting Group, BCG, and thought it was a great opportunity. When I was at IAC in New York, so made the move out from New York to LA to help them kind of build the fund and build the platform.
And how much of that felt like you're in a corporate venture capital environment compared to a pure financial return? Boston BCG was an LP. Did they have economics in the GP, or was it pure LP?
Yeah, I probably can't comment on the economics, but I mean, I'd say the Jeff thesis, obviously an independent fund with the underlying thesis of trying to find great returns for our LPs, but BCG was, extremely helpful in kind of, seeing the value add of kind of technology companies for their clients. So definitely a win-win synergistic relationship where we'd invest in a company, and knowing that there was demand for kind of corporate, partnership or corporate kind of, I'd say, acceleration via kind of some contracts or business development. And then I think from the flip side, BCG was extremely smart about how they thought about the partnership with B Capital, because they were really kind of introducing technology to all some of the most prestigious companies around the world, through the partnership with BCG and the portfolio. So a great partnership, and I think kind of speaks to the quality of the portfolio today. Companies like Evidation Health and iCertis and NinjaVan, you're really kind of punching above the weight, getting into some of these great kind of I'd say game-changing technology companies.
When I think about, I spend a lot of time thinking about corporate venture capital. I've written books, and a lot of our LPs are corporates. But it's kind of like, damned if you do, damned if you don't for a systems integrator consultancy that recommends technology to their clients, if they have if there's a category of three companies doing, I don't know, automated customer support or bots or something, some AI to automate something, if there's three in the category, BCG should be trusted to figure out and recommend impartially the best one. And if they've got, you know, a bet on one of those horses that they've invested in, it's hard not to push the one that they've funded, even if it's not the best one. So that's like the negative side. The positive side is, who are they to be recommending anything if they're not VCs? So a VC gets a fuzzy thumbnail of what the future looks like, because startups come into your office and pitch you today what's going to be tomorrow. So by being in venture, they really have their finger on the pulse and they can make smart recommendations. If they're too motivated because there are LPs in one, you know, I kind of wonder. So that's sort of, you got to surf a fine balance of those two. Did that ever come up?
Yeah, I mean, I wouldn't say that was the case. I mean, BCG obviously does first and foremost what's best for their clients. So, you know, the example you mentioned, I don't think really came to fruition in my time with the fund. You know, they took kind of an independent lens of you know, doing what's right for their clients. I think the B Capital angle really just gave them additional data points to make smarter decisions. They're seeing trends, they're seeing technology, and really kind of have the pulse on innovation. So the recommendation they make for their clients, you know, first and foremost is what's best for their clients, but now it's kind of a more informed, data-driven decision.
And were you able to get portfolio companies to talk to partners at BCG and actually access their clients? Because I mean, every city I've been to, I think BCG has an office in. You know, they're kind of everywhere. So
Yeah,
does that mean you were getting into banks in Poland and just really delivering value to the portfolio, or maybe not as much?
no, you know, extreme kind of global organizations. You know, B Capital is a global company with offices in LA, SF, New York, you know, Singapore, where kind of our Asian headquarters are, and BCG's obviously kind of global locations and reputation speak for themselves. So it's pretty synergistic in the fact that a lot of the technology and, you know, opportunities we were looking at were kind of global first. And, you know, underlying thesis that Raj and Eduardo had of building B Capital was, you know, that innovation can really come from anywhere. So I think that kind of speaks to both funds given the large global footprint they have.
Right. Right. Well, cool. So tell me about Antler. Tell me the story. So when did Antler start? What was your role in it? And then we'll get to what you're doing today.
Sure. So Antler started about 4 years ago in Singapore by Magnus Grimland, you know, who also spent time at Rocket Internet. And he has really kind of built this global platform of Antler. We're in 15 countries around the world. We have, I think, close to 200 employees. Really investing and kind of finding the next wave of entrepreneurs. So kind of through, you know, Antler US, which I run with a colleague of mine, a former colleague at B Capital, and another Rocket Internet alum, kind of a global program in the US to be the first money into a business. So really institutionalizing the friends and family around. So we'll often kind of be the first check-in to someone that has, you know, a strong track record, as you know, has an exit, has kind of understand what it means to build a successful business, or someone that, you know, comes from McKinsey, a Bain, a BCG, or a Goldman, and kind of has the operating a business experience to be successful. So we'll work with them very closely for anywhere from 2 weeks and kind of pay them a grant to, you know, leave their kind of prestigious job to kind of work with us on the ground to help build a business. And then we'll usually invest in kind of the top portfolio companies that we kind of help create. So we'll, you know, usually invest, you know, a few $100K at you know, in a convert note into these companies and be really the first money into the business. And then we'll go to market and kind of help them scale and build up the platform. So as you mentioned before, with kind of the SPACs and the tremendous amount of capital just broadly in venture and growth equity, you know, the general thesis is to be the kind of the first money in and really kind of create a winning portfolio. So we have 18 companies in the U.S., really scattered across both coasts, focused on, you know, everything from enterprise software to fintech to B2B2C. So really kind of a broader portfolio approach where our thesis is we can predict the next wave of tech winners by picking the entrepreneurs and the CEOs that really drive growth.
And so you're sometimes giving a grant for someone to leave their job, and kind of reminds me of biotech where they pay somebody to walk around and try and buy an asset that's getting orphaned or something. But you pay someone for a couple of months or a couple of weeks, or how long does that
Yeah,
last?
we'll give an individual grant. It's usually 10 to 12 weeks, and it allows us as a business to really work with them. So we're hand in hand with weekly calls and daily Slack messages, thinking about areas, thinking about addressable markets, how to monetize a business. So in that 10 to 12 weeks, a lot of the time, we're really shaping, I guess, the future of the company. And then I'd say in the latter portion of that 3 month run, the companies are starting to get traction, product market fit, where they're getting revenue, customers, and really starting to scale a business. And that's the point where we come in and kind of, I'd say, institutionalize that friends and family round. So instead of going to a seed fund or trying to wrangle angels, will really be the first capital into the business. And we really have taken almost Andreessen Horowitz approach to seed, where we have kind of an in-house tech team, an in-house product team, marketing. We work very closely with our companies on fundraising. So when you come to Antler, even if you've been successful in the past and have large exits, our thesis is we'll wrap it around with resources to make sure your next venture is as successful as possible. So a lot of that is kind of the team in the US, and we have 15 people kind of scattered across New York and LA.
Okay, so that sounds like a studio approach. When you're actually funding the company, being the first in, and wrapping it with resources from this 15 people, doing even some development work or engineering work, are you getting equity for that, or are you wiring cash to them and some of that cash gets paid back to you for services, or how does that work?
We do charge a program fee, depending on how long we work with the company. So usually it's very minimal, and it usually only comes out if we do, an investment. So if we do a 300K investment, we'll take back, 50K or 25K based on kind of our resources. So it really depends. And I wouldn't say it's kind of a traditional studio model, given kind of, we're really letting the individuals drive and pick the company that they're successful in. We also do traditional, I'd say, pre-seed investing, where a company has traction, they have revenue, and they have customers, and they see value in the Antler team and the Antler resources. So a part of our business model, I'd say, is pre-seed investing, where we're competing for I'd say external deals and trying to win based on kind of the resources we have. So it's kind of a dual pronged business model.
Yeah, I think it's good. I mean, I remember the first time I heard Dave McClure tell me he was getting management fee and carry on his revenue. I thought that was pretty genius. Because the original accelerator model was, oh, we're going to take 6% or 3% of all these pre-seed companies. We've only got enough cash to run this for 2 years. 2 years will, zoom by, and there's been no meaningful exit other than some acqui-hire where nothing really came back. And so he started investing into the company and charging them fees. And I was like, dude, you're getting management fee and carry on your revenue. That makes you a genius, But
That's
but
an interesting model.
but it sounds like if you're maybe de-risking the risk associated with that early stage by making sure they don't screw up certain things, even, and quickly, rapidly, cost effectively deliver things they need. And so it's probably a good, they see it coming.
And to clarify on that, yeah, we only take what we call a program fee as what we invest. So if for some reason we invest, or the relationship's not a fit, or we don't see it, we don't really monetize that. And I think we have been very careful to really kind of work with individuals that see the value of the broader platform. So if an individual over that 10 to 12 week period, or even in some of our external seed deals or pre-seed deals, don't see kind of the immediate fit, they can walk away. So we have kind of been, I guess, careful on how we built the program and selected that.
Makes sense. And Bryan, what do these deals look like typically? Like, how many? You're the first in. What is the range of check size when you're taking your first bite into the company?
Yeah, so it's a great question. So I'd say standard check size right now is usually kind of 2 to 300K at a $2 to $3 million convert no cap. And then the way we're structured is we're really double down on the winners. So this vehicle that I run in the U.S., with my two partners, we'll kind of continue to fund that, which we would call the traditional seed round, and then we'll fund it in the A round as well. And then we also have a global venture growth equity fund that will fund companies kind of past the Series A. So the interesting thing when entrepreneurs come to Antler is really kind of investing throughout, a company's journey from, pre-seed and idea all the way to growth. So, obviously fundraising is a time-consuming business where you want to make sure you pick the right partners. So we offer capital through I'd say the entrepreneur's kind of full stack and their journey.
Okay, and if you're investing at 2 to 3 million caps and a company sells for 20, 30 million without raising more, you're getting a 10x. You're not dependent upon unicorn exits, right, to drive your cash on cash absolute returns or even a decent IRR. What are your
Yeah.
thoughts around, what is your thinking of that? Or is that a small percentage? Are you 80% double down with your fund? It sounds like Antler's got different vehicles.
Yeah, Antler does have different vehicles. I mean, I guess our core pre-seed fund and then the growth vehicle. I'd say that the interesting thing to your prior comment of getting a company to 20 to 30x is usually when a company kind of comes out of our, I'd say, program or we do a seed deal. A lot of the times, it'll be under a $3 million valuation, but that company in the open market is probably worth $6 to $10 million right now. So I'd say the vast majority of our companies immediately after we invest, it'll be a markup. So somewhere in that 6 to 10 range. So those guys will usually raise 2 to 3 million, and it'll be at a 6 to 10 in some form of either price or convert no round. So there's definitely a markup that occurs. But to your prior point, I think for us getting 100x, that's us exiting in 300 or 200 million kind of in an acquisition or a secondary market. So our 100x is different than someone that puts money in at 100 and trying to buy it up to IPO. We invest so early, we often get out earlier as well.
And on secondaries, do you have any policies for that? I mean, if you see a company's values going up and your inside view says this is not working, that's different. But in a general positive, rosy environment, like we've got companies that I thought that I would be selling 20% of our position at Rubicon and 7BC, but I have trouble doing it. I just tend to want to hang in a little longer. You could put points on the board. It just seems like short term to do it. But I think if you're investing at these $2 and $3 million valuations, and then Andreessen Horowitz puts in 30 million at a 250 million, it maybe makes sense to go to zero cost on everything and completely de-risk the fund. What are your even feelings or policies around when it makes sense for you guys to divest some or all?
Yeah, I mean, it's a great question. And, obviously each company is a case by case basis. And, obviously given the growth environment we're in now, I think, obviously cyclical in nature. So we don't have kind of an underlying policy. I think the interesting thing about the Antler model is obviously the multiple vehicles that we talked about before. So, even if our vehicle, initially comes out at, the Series B or Series C, we do have another vehicle that kind of leads Series A through C rounds. So, it really depends on the circumstance. I'd say that, obviously, what's going on in the growth market is extremely competitive right now. And, a lot of companies are kind of raising quicker rounds at higher valuations than they were 16 months ago or a year, even a year ago. So case by case basis, I mean, we don't have any internal policy, over the course of the fund. I mean, it's a 10-year fund, so they can make the best decisions kind of for our LPs in that course of time.
And when you do a 200 to 300K check, are you going solo, bringing in the studio element, and then hoping to raise a quick up round, like in the fair market? Or is your 200 to 300 highly syndicated? I would think some entrepreneurs really put it together. They say, we got Antler, why don't you get in too? What's happening there?
We take that whole initial slug, given kind of the hands-on approach we have, and then we'll go out to market, with the companies immediately after and target that 6 to 10 million range. So, we've had kind of numerous funds kind of invest, I'd say, within 30 to 45 days after we close, there's usually a subsequent round where it's a, a 2 or 3x kind of, markup from our initial position. So we'd like to kind of, I'd say, start off by taking the whole slug, and then we'll kind of do super pro rata in the next round or two.
So what is your unrealized IRR? You must have some big unrealized IRR numbers that see such a rapid growth. Um,
Um,
maybe you don't want to
no,
disclose that, but
I will, I
probably
will
shouldn't.
spare those numbers given kind of where we are right now. But I'd say we had some great news. I think about 6 or 7 days ago, one of our companies, Marco Capital, which is in the trade finance space, announced kind of a round from Struck Capital in LA, as well as a $25 million debt facility. We've had a bunch of other companies kind of raise from Sequoia Scout funds and different kind of, I'd say, well-known, either Bay Area or New York institutions. So, the portfolio is doing very well. About 65 to 75% of our companies, immediately kind of after we invested have already kind of risen that next round. And we try and participate in that round heavily as well.
Got it. And what's your sense how many companies do you think you should have in a single vehicle portfolio to adjust the risk for the stage you're investing at? Like in general, if you've got like all EBITDA positive companies that are generating 5 million quarterly EBITDA, you could have a smaller portfolio. If you're investing very early, you probably want to see a much wider set to not break a sweat when some of them start to run out of money. What do you think is the ideal set of companies for a pre-seed? Because you guys sound like, I would call this pre-seed.
Yeah, no, I think, we're really investing in, I'd say about half of our business model is investing in great talent. And then the other half is kind of, I'd say, traditional kind of pre-seed seed investing. But we'll probably do about 125 initial investments out of Fund One. So Antler has been around for kind of several years in Asia, and I think that's the benchmark that we're kind of going for, given we do have kind of some I guess established kind of vehicle kind of parameters, but it'll probably be about 100 to 120 companies in Fund One.
Okay, and so that's 100 to 120 in one vehicle. Was that the number?
Yeah, in the first vehicle, correct.
Yeah, I mean, I think that when you do that, it's it's illegal from the SEC to say I guarantee you're not going to lose money, but if you're well connected, it's very unlikely that you would lose money. If you've got a huge outlier in there, 119 are going to bring down a little bit of the impact of it. But especially if it's viewed as a feeder fund for other vehicles, or if a big percentage is on the double down, getting that wide set to create the opportunities to put most of the money is good. What percentage, what's the number of companies that you double down into? Or maybe it's hard to say. Like at Rubicon, we used to say 30% of our cash, of our dry powder, is spread across 25, and then 70% is double down, and generally never do more than 10%. So if you never did more than 10% into one, and you did that 5 times as a double down, 50% of your fund is concentrated in 5 companies. So you're going to feel it when one of them is a Facebook or a Google, At the same time, you've really taken away the risk of coming in early by the diversification. But what percentage is double down? Maybe that's a simple way of thinking of it.
So I'd say the simple math is probably a third. But we'll do kind of our super pro rata in the next 2 rounds. When you run through the math and the numbers, it's obviously a little bit different given we have a later stage vehicle. So obviously doing what's best for kind of our LPs in the fund, but it's a little bit different that we have, I guess a later stage vehicle. But about a third of the companies will kind of aim at doing super pro rata or pro rata in the next round, which is, I'd say usually kind of a seed or a small A, kind of given where we kind of work with them to kind of be after our investment. And that's the benchmark. I mean, I think, to your prior point, we've had some early breakout winners in the US where, you can see kind of why we'd want to double down. So I think the future will tell the story, but, so far we've had a couple of companies that we're really excited about.
That's good. And so you guys are on the pulse of this pre-seed, seed, and even how they turn into late seeds and A's. What is COVID is got winners and losers, but what are you seeing net net? What's your sense of how the market has changed from, you know, Q4 of 2019 to this amazing 2020 year we're so blessed to be sailing through? Like our valuations,
That's
I mean, a 2 million, it's hard to see a 2 or 3 million valuation get lower for a hot team coming out of Goldman or Rocket or wherever. What have you
yeah.
seen on
No, I mean,
valuation?
it's a obviously, I think it's a unique environment now. I mean, our pace has picked up because we see a lot of opportunities in white spaces, whether it's esports, enterprise SaaS. I mean, I think even though a lot of kind of real estate and direct kind of interacting sectors have felt the brunt of COVID. I think from a technology standpoint, and not even in seed, but through venture and growth, and even the public markets. This has been a pretty wild ride the last 6 months. So we've seen a huge uptick in deal flow. We're I'd say valuation where we get in is kind of what we pride ourselves on, kind of getting in first. So we do kind of for some investments go higher, some investments go lower. It's really dependent on the team, but I'd say that the overall quality of individuals that have I'd say the quantitative and qualitative skills to really build the venture backed company has increased wildly in the last 3 months. And then the sectors and the opportunities that they're chasing has really kind of given them a lot of white space where, in 2019 or 2018, a lot of these companies they were going to build, whether it's, esports, teleconferencing, digital health opportunities weren't there. So it's been a very interesting time for us. We've been extremely busy on the deal flow front the last 2 to 3 months.
And I was on a bunch of VC Zooms early in the pandemic, and I still do them, but there was like a million a day at first. And I was surprised to hear so many VCs saying, I just can't invest over Zoom. Because for us, we've had an office I'm in the Valley, and we've had an office in New York for the last 10 years. And so our New York team finds a deal or we find a deal, and we talk to the founder over Zoom with the comfort that our other team has met them in person. But do you see did you see people struggling to make a commitment without kind of Larry David looking you in the eyes in person, or
Uh,
and are we done with the I can't handle Zoom investing? What do you see there?
I always love a good Larry David reference. I mean, I think for our program, a lot of it, the first 2 or 3 months, we're kind of adjusting, and I think the relationships that we have built kind of over time with other VCs, and kind of doing more reference calls, and really kind of trying to find different data points to supplement the information you get from a face-to-face meeting was a big priority for us. I think now it's definitely turned a little bit, kind of everywhere from kind of say seed to growth, where not only are people kind of getting walking coffees, but I think they're kind of utilizing different data sources, whether it's reference calls or speaking with individuals that have worked with them in the past, or doing on sheet or off sheets. They're just more, I'd say, resourceful in kind of how they diligence a founder. In Antler, we really invest people first, so that's kind of
Yeah.
our job is to make sure that that person is AAA quality. And you can tell a lot by someone, but if they worked at Goldman for 10 years and went to HBS or went to Stanford, I think that's a good quantitative data point. But we kind of pride ourselves on kind of doing the qualitative research, and doing those reference calls and really speaking to people. So it's been an adjustment, but I think net where we've netted out is definitely more efficient, where we can really kind of get the wheels on the bus churning faster, and be more diligent in kind of how we look at a founder. So that's kind of how our stance has been. It was a 2 or 3 month adjustment, but I think now we're probably a little bit more efficient than we were kind of pre-COVID.
Yeah, I think in a world of social injustice where there's not a lot of women in the industry, despite there being plenty, it's still nothing like it should be. People of color, their involvement, and in this world of investing over Zoom, where we're saying, well, I only want to invest in deals if Bryan knows them, and I've known Bryan for years, and it starts to be this insulated white male thing, and just something to think about when you're saying, all right, well, if I can't meet you in person, I got to know that a lot of people I can back channel. Like, I don't ask for references, I make my references on people I figure out that know you. And if you're dealing with people from outside of some of these privileged circles, it gets harder in this COVID world, you know? So it's just something to think about. You know,
And we definitely, I think, we pride ourselves on diversity. So I mean, a big portion of our investment thesis is a lot of those individuals that you mentioned before. The resources that they have historically had to build the company have been lacking, and I think our underlying thesis is we have kind of that underlying platform, whether it's fundraising, marketing, product, tech, to kind of help them get through that through that kind of stereotype. So it's a big push internally at Antler.
And Bryan, that's good to hear. That's good to hear, and it's needed. With you going from New York City to LA and back to New York, without upsetting either side, all everybody at the same time. What's your perspective on? I mean, I love LA, and I'm from New York originally. I've been out in the Valley forever, but like, I think LA is just a creative place and it's a fun place. Whereas I wouldn't wish anyone to live in the Valley if they're single. Um, but what's your sense of LA become? It's the second biggest city in the world, and it's not number two when it comes to startups and venture yet. What's your sense?
Yeah, I mean, I'd say when I moved out to LA 5 years ago, the ecosystem was definitely really focused on consumer and media and really leveraging, I'd say, the Hollywood kind of, I'd say corporates and conglomerates that were there. I think the tide has definitely shifted, and companies like Dollar Shave and Honey that have had meaningful exits have really kind of, I'd say, propped up a new wave of companies. So, I think LA on a whole, definitely long. I think there's still some vertical bias. Companies are really kind of operating in 4 or 5 verticals, and it's probably not as diverse as New York or SF from a sector perspective. But I think it's tough to argue with kind of the traction, and there's definitely been an uptick, I'd say, in the last 2 or 3 years, not only on the number of startups that come out of LA, but also the number of venture funds that are kind of raising larger funds and really focused on the ecosystem. Even Silicon Valley kind of heavyweights that have a satellite office down there now. I think there's definitely been a push by LA to really kind of diversify outside of kind of consumer and media the last year.
You probably know Kelly Purdue because he had Roto Hog, so he was in fantasy sports like a way long time ago, like you were. But I went down to LA to hang out with him, and maybe more than 10 years ago, he took me on a walking tour of Santa Monica, and there's nowhere. Maybe there is now, but at the time I said there's no way you could walk in San Francisco or the Valley and hit 11, Mucker Labs, accelerators. It was, and then you had like, what was it? Amplify was down in Venice, but that's
Yeah.
like, you could walk that still compared to a lot of places. So I thought it was pretty interesting to see that density. It's almost like that's what bad traffic will do to you. They'll force everybody to be in walking distance because driving to Beverly Hills is like, you need a helicopter, right?
Yeah, no, it's true. LA definitely, having lived it, doing the reverse commute from Santa Monica Manhattan Beach. I mean, it's definitely tough driving. I think the positive though is that Venice and Santa Monica, there's really kind of pockets of not only funds but early stage incubators and companies. So it's definitely from a day working perspective for people not in tech, not in venture, definitely a little bit tough to navigate given lack of kind of public transportation. But as you mentioned, I think there's 3 or 4 pockets in LA, and Culver City is definitely on the up and up where it's easier to kind of move and kind of I'd say interact with people in person, and TBD if that even matters in 6 months with COVID. So LA I think is probably well positioned, I guess, given from the current work from home environment, given the amount of kind of talent they have down there.
Well, I've only been starting to take meetings recently, and the funny thing is, I do a fair amount of driving from SF to Palo Alto and all around here. But when I get in my car, I'm like, who am I going to call? Who am I going to call? Whenever I get in my car, and now with COVID and lockdown, I'm just like booked. I don't have this like office hours of I'm going to call my aunt and I'm going to call that entrepreneur while I'm in LA traffic and enjoy it. So I kind of, you know, I don't complain about the LA traffic when I'm down there because just it's an opportunity to get on the call or have somebody in the car with you. But cool. So what tell me about the international side. It sounds like not everybody has the international component that you have. So a lot of people just having the option to talk to someone about international that has resources on the ground. Where are you guys outside the United States? Like, what are the cities you're
Uh,
in?
yeah, so we're in 14 countries around the world. In New York, I mentioned we're LA, New York focus. Our core hub internationally is in Singapore. So we've been in Singapore for 4 years. We launched India last month. We're in London, Oslo, Sweden, Amsterdam, Sydney, as well as in Nairobi in Africa. So definitely kind of a global presence. And we all, I think, leverage kind of internal kind of data and tech and resources. And I think it's especially helpful for companies that want to expand internationally to kind of put them in touch, on the ground with that team or, corporate partner or a venture funder on the ground. So kind of a global first approach to what we're trying to build.
And sometimes LPs are just these anonymous pension funds and endowments that have nothing to do with the GP layer or the startup layer of the stack, but other times they do. Do you have, like, is Temasek an LP in Singapore, or is it large corporations or families? What's the cross section of LPs that helps us understand Antler from the outside?
Yeah, so it's a great question. I think, can't comment on too much specifics, but publicly, Eduardo Saverin, who obviously worked with IP Capital, is an early stage investor. So individuals that have, a successful kind of track record as, operators and investors seem to understand the Antler model pretty well. And then, Schroders, which is a large kind of financial institution, we disclosed that, I think, about 4 or 5 months ago.
Is
So I
that
think
is that
there's
Schroders Advec? So Schroders acquired Advec, which was a $10 billion fund of funds out of Zurich in New York. Do you know? Is that the same thing, or is that different Schroders?
uh, it's the European, the British based investment manager. I'm not sure on the exact
That's okay.
the
Okay.
exact.
Okay. Because the founder of Advec, which sold to Schroders, is one of our largest investor out of Switzerland. Um, but he stepped down a few years ago because of age. But okay. All right. Well,
Oh,
listen, that's great.
small.
And Bryan, in closing out, any predictions on the exit market? Are you going to see pre-revenue companies banging out SPACs, or what's the exit market for an early investor like you and even us?
I think it's a great question. I mean, I think obviously a lot of it is driven by public markets, which I think on who you talk to, I think there's obviously some unforeseen kind of things that the market's going to have to take in, like election and kind of COVID and how it evolves. But I think from a venture and growth perspective, there's really been an influx of capital from everyone under the sun. So I think that the exits will continue to be there, and the capital will always be there for the best companies. So I think this COVID environment has really kind of minted large tech as kind of, I'd say, a potential acquirer, as well as kind of a exit option for a lot of these startup companies. So my prediction is definitely, I think 2020 is going to be a record year for growth for the majority of tech companies, and I think the exits will definitely be there next year.
Sounds good. Okay, my friend. Well, listen, we'll be thinking of you when we see these early stage deals, and hope you can take them to the next level. And don't forget us when we want to invest in them again. And it sounds like it's a pretty
No problem.
broad remit. And I know you're
Yeah.
LA and New York focused, but will you invest in companies across the US or Canada, or where do you?
Across, yeah, we're global in nature. So I mean, we a good portion of our companies are in Chicago. We just announced our Latin American office down in Rio. So I mean, we do the full Americas is the best way to put it. So if you're an entrepreneur anywhere around the globe, definitely reach out to Antler. I think we have a unique model and can definitely help no matter where you're located.
It's amazing. I think it's great. I think it's great to see talented people doing what you're doing in a way that's not going to lose money and could potentially make a lot of money. So it's all good stuff. Okay, Bryan, listen, thanks so much. Stay safe and hope to see you in the real world sometime soon.
Likewise, have a great day.
Okay, thanks so much. Bye-bye.